So in October, the Central Bank published a discussion paper as a first step to reviewing our Consumer Protection Code with a view to hearing from the Irish public and stakeholders about how consumer protection in financial services should evolve to remain fit for purpose and effective. So to start this next discussion, I'd like to invite Central Bank Deputy Governor, Consumer and Investor Protection, Derville Rowland, to the podium. Derville will first talk to us about the Consumer Protection Code Review discussion paper and then chair a panel discussion about delivering for the consumer in a changing world. Welcome, Derville.
Good morning, everybody, and I'd like to welcome you to the second session of our Financial Services Conference focusing on delivering for the consumer in a changing world. I just want to start by kind of framing this day. In 1988, a talented computer student in Berkeley, California, unleashed a computer program as an experiment, which was then the early internet. In fact, the program was a cyberworm, and within 24 hours, it had spread and affected 6,000 of the 60,000 computers that were connected to the internet at that point. Well, the FBI investigated and later said, whether accidental or not, the first internet attack was a wake-up call for the country and for the cyber age to come. And I mention this because it tells us a story that while progress is generally good, it can invariably carry some risks and bumps along the road. So in the book, The Future of Money, the author writes very fluently on the issue of innovation in the context of financial services. And he says that fintech is changing the world of finance, providing more direct channels that connect savers and borrowers, and at least will yield an array of financial products and services that better meet the specific needs of households, entrepreneurs, and firms. But of course, the flip side of this is that financial innovations will generate new and as yet unknown risks, especially if financial market participants and regulators put undue faith in technology and let their guard down. So a cornerstone of the central bank strategy is that we create the regulatory context in which the potential benefits of innovation for consumers, businesses, and societies can be realized, but ensuring that the risks are effectively managed. It's therefore essential that we carefully consider the consumer and investor and the impacts on the transformational changes that we are seeing in the financial services sector. But this is not just a responsibility for the central bank and the firms that we regulate, but of course for the wider state consumer protection framework as a whole. And the importance of the national framework, the critical role played by each component part, from ensuring competition to promoting financial literacy, is something that we hope to draw out in our discussions today. We also want to focus on the way in which the central bank delivers on its own mandate as part of that national framework, and the review, of course, of the Consumer Protection Code is a central part of that. And we really will seek your views and try to get you to participate with comments and questions in the panel discussion that follows. But I want to give you a brief overview of the central bank's approach to consumer protection. And to begin with, it's really important to emphasize that our work to protect consumers is delivered right across the entirety of our organization. The breadth of the central bank mandate enables us to harness our collective wide-ranging policy, economic, financial stability, and regulatory expertise. The stability of the system and the resilience of firms within it are as essential to protecting consumers and investors as our statutory codes of conduct, assertive supervision, and robust enforcement powers. The central bank works to ensure that the financial system can provide services that households and businesses require, both in good times and bad, and that they are provided in a way that is fair. Fairness, in fact, is the cornerstone of consumer protection, and firms must act in their customers' best interests, and that is critical to maintaining trust and confidence in the financial system. but it's acknowledged there is an imbalance between firms and consumers. A customer buying a financial product for the very first time is unlikely to have equivalent knowledge to the professional selling it. The relatively high value and longer time frame of many financial products can increase the impact on consumers if things go wrong. So it follows then that there is a need for strong rules to protect consumers. And these rules place an onus on regulated firms to put the best interests of customers at the heart of everything they do by designing and developing products with the consumer's interests in mind, by putting the necessary resources, processes and controls in place to ensure that the product is sold in a responsible manner that takes into account the circumstances, the needs of the consumers concerned. And this includes, where advice is sought, the most suitable products from the firm's range is selected for recommendation. And importantly, where mistakes occur, and they will, that they are fixed definitively, swiftly and comprehensively, ensuring affected customers are appropriately dealt with. And firms must abide by these requirements and principles irrespective of the environment they're operating in or the business models that they pursue. Here in Ireland, we are seeing a wide range of structural changes in retail banking arising from consolidation, branch closures, withdrawal of in-branch services, and the outsourcing of certain activities. We're also seeing a rapid evolution in products and services and in how banking, insurance, and other financial services are being provided to customers, including through mobile and online delivery channels. Change and innovation provides opportunities for firms to transform their business models in order to grow revenue and extract cost efficiencies. Change and innovation can also bring clear benefits to consumers with better access to financial services, greater choice of product and provider, and new tools to help them understand and manage their finances. However, these new ways of doing business can present risk for consumers too. And therefore, firms need to be very clear that it is their responsibility to identify and mitigate and manage these risks. This can include, for example, risks from the speed and ease at which transactions can be completed and the absence of any human interaction or advice to support consumer decision-making now and in the future. The extent to which personal data is available to firms is also a key issue, open to the possibility of misuse, but it raises complex ethical questions on the appropriate use of that data. And some consumers are excluded from services because they cannot access or struggle with technology. So accessing financial services now not only requires financial literacy, but it also requires a level of digital literacy too. And this is a challenge for our country that goes beyond just financial services, of course. However, if the prevailing plan of firms in financial services is to increasingly migrate to digital delivery, much of which places greater onus on the consumer to access information to inform their decisions, then those firms who are pursuing this business strategy have a corresponding duty to play their part in building the greater levels of financial and digital literacy that consumers will require as a result. All of which is why we say that we want to foster not just an innovative financial sector, but one that is resilient and customer-focused and sustainably serves the evolving needs of households and businesses. But it's not just about technology itself, it's also about the financial environment, which the earlier discussions and our wider experience tells us is becoming more challenging. So firms having a key focus on the regulatory requirements that are already there to protect consumers is really important. Affordability and suitability are at the forefront of the customer journey. Provision of clear, relevant and timely information. Proper product governance and proper governance over sales channels. operational capacity, especially to support consumers facing financial difficulties or under financial pressure. All of these requirements are rooted in the Consumer Protection Code and associated statutory codes and regulations, which brings me specifically to the code itself. In implementing the mandate, the central bank supplements the relevant European Union and domestic law with codes and regulations modelled on international best practice. And the Consumer Protection Code is at the cornerstone of that framework, comprising a set of rules and principles that firms must follow when providing financial products and services to consumers. It was first introduced in 2006 and has continually been amended to respond to the evolving risks and circumstances over time. And 3 core points are important in this context. First, the Code has enabled many of the key interventions to protect consumers in the past, such as the tracker mortgage examination and our work on differential pricing. So the Code has served consumers well. Second, precisely because we continue to update the Code, it continues to drive our work to protect consumers on a daily basis. We undertake an annual consumer risk outlook and we publish that. And in that we identify emerging risks and we use the Code and the wider framework to ensure that firms are working to mitigate those risks, for example, in account migration. And thirdly, and looking to the longer term, financial services are rapidly evolving, in particular in the way products are now accessed through digital means, so the Code must evolve and continue to protect consumers into the future. And it's really important as an open and engaged organisation that we consult widely and deeply when proposing changes to these rules and regulations. Many of you will be familiar with our formal consultation papers, and in the case of the Code review, we decided to introduce an earlier phase, a discussion paper, in order to evaluate fully the complex consumer issues that are emerging from a significant societal and technological change. Changes to the Code must be informed by the experience and insights, both by those who we seek to protect, but also by those to whom we regulate. That's why, in publishing our Consumer Protection Code Review discussion paper, we have set up an extensive 6-month engagement phase where we will, through digital, physical meetings, online, seek to engage and hold debates about these issues, and we will publish the feedback that we get. It's important that when we move to suggest the contents of a revamped code, that it is informed by the many different perspectives. And we want that extensive engagement. When we published the discussion paper, we covered 10 key themes, and we've broken them into 3 topics. The first is consumer interests. These are best served through effectively functioning financial service markets, providing appropriate levels of availability and choice through well-run, consumer-focused firms which act in the consumer's best interest. An important aspect of regulation is finding the right balance between reducing risk to consumers and ensuring regulatory requirements do not restrict their freedom to choose the most appropriate providers or products for them, or indeed that regulation is proportionate and does not impose unnecessary or undue financial burden or cost. And we seek your views on this balance. The second strand is change and innovation. Innovation undoubtedly brings real benefit and risks for consumers. In our daily lives, many of us experience the ease of access to financial services through digitalisation. However, digitalisation can limit access to basic services, and there can be an instantaneous engagement that may have buyer's remorse associated with that. Technological automation too needs to be considered. And again, we want to hear from you on the benefits and risks to make sure they're mitigated, but we want to hear about how to strike the right balance. And the third strand is availability and choice. Effective market functioning requires consumers to have access to clear and unbiased information in relation to products and services. Clear disclosure of product features, risk, price, all of that allows customers to select the provider and the product that can best serve their needs. So, promoting competition among firms is relevant to availability and choice, and where a market functions well, competition supported by transparent and fair disclosure drives fair price formation and improves choice. The transition from traditional to digital-based delivery is having a positive impact, but there are risks too on consumer availability and choice. And we want to engage about the role of high-quality regulation within an effective context, one where innovation benefits consumers, where there's transparency on the part of firms, and there's healthy competition between product providers. This combined, we believe, best supports consumers to access products that will serve their needs, and vibrant choice is relevant to that. So, our discussion today represents just one part of the extensive engagement that we want to have on the Consumer Protection Code, but the wider discussion around some of the issues that no doubt will fall in the national framework. And I will leave it there from my introductory remarks and say that I'm delighted to be joined by a very esteemed panel who no doubt will have all the answers for us and will have the problem solved, I hope, before we go for lunch. I'm delighted to be joined by Kevin O'Brien, member of the Competition and Consumer Protection Commission, formerly of the Central Bank Parish, Eamonn Crowley, President of the Banking and Payments Federation Ireland, and of course the CEO of Permanent TSB, Patricia Rickard-Clarke, Independent Chairperson, Safeguarding Ireland, and a member of the Central Bank of Ireland Consumer Advisory Group, Neil McDonnell, CEO of ISME, and Professor Pete Lunn, the ESRI. So if you'd join me on the stage, I'd be delighted. So I promised the panel when we were preparing for this that we would try to have early audience participation. But I hope you forgive me if we try for one round ourselves first and then see if we can generate some interest from the audience. And of course, we have a lot of people online as well, so questions would be very welcome. Maybe I'll go to you, Kevin, first, and ask you about the work that you do now with the CCPC, but also recognising that you had a lot of experience in the central bank in consumer protection policy, no less. What's your assessment of how the financial system is serving the consumer? And small business, of course, is captured in the Consumer Protection Code and very relevant. What do you think is working well, and where do you think we have more work to do?
Thanks very much, Derville, and thank you for the opportunity for the CCPC to come here today. And just personally, it's great to be back among colleagues and friends. The CCPC has quite a broad remit, and we come at financial services maybe from three different perspectives. The first is as a competition authority, and a key piece we have there is merger control. And it's actually been a very busy 12 months for the organisation in relation to financial services and merger control. A second function we have is general consumer information and consumer outreach. So that'll include a whole host of issues, but obviously it's very topical at the moment around current account switching. And in that context, we provide money tools. So it is the public body go-to place for comparison in relation to financial services. And then a third element of our work is a specific mandate in relation to financial education, which was talked a lot about this morning. So I suppose coming through from those different perspectives, maybe a few comments. I would structure them around the idea of consumer choice. What we've seen in the banking mergers has been unfortunately a constriction in choice. We've obviously very familiar with the departure of Ulster and KBC, and the transactions around those departures went to the CCPC for merger approval. In some cases, there were conditions attached, mainly to protect consumers in terms of their existing mortgages. But what you see over there is a reduction in service, and that is of concern. It's timely that the Minister mentioned this earlier, that the Department of Finance, of course, is doing its banking review, and that can pick up on a lot of the issues there. It's not just consumers. I think a particular concern we called out was provision to SME, where there are a lot of niche services that some banks provide to SMEs, and there will only be 2 players left in the market doing that. At the same time, a lot of our merger activity means we look into different sectors like payments, insurance, and we see an awful lot of new activity, new entrants. So there are positive stories, but I suppose the banking one is the one where the biggest concerns are at the moment. Maybe the second thought I might bring is horizontal consumer protection is obviously a key part of what we're about. And a big element there is something called the Digital Services Act, which has just been enacted at a European level. Now, a lot of this will not concern financial services directly, because financial services, of course, has authorization and closer supervision. In fact, a lot of the DSA activity will regulate for the first time, really, some of those very big platforms we've become familiar with. But there are a couple of elements that DSA is focusing on, and you touched on them earlier. Advertising in a digital context is very sophisticated. The phrase surveillance capitalism is one I've heard used in the context of DSA. The Consumer Protection Code today deals with advertising, but I think the sophistication of regulation around advertising is going to have to take a big step forward. It will for lots of other sectors, and I think the code is an opportunity in that regard, given just the complexity, the nature of nudges, the approach, the weaponization, some people would say, of behavioral economics. And just a third thing that looms large for the CCPC today is the cost of living crisis. So we're engaged in discussions around all sorts of different issues. But in that context, we would be conscious of that rush to credit, and perhaps that risk now here more than it was before, of consumers seeking easily available credit that might not be the best choice. So I'll stop there for the moment, Derville.
I think we'll hear more about some of these issues later, but I'm going to ask Eamonn next. You heard me in my opening remarks, and it's tried to say, but I think post-COVID, the move to digitalization has just been further accelerated. And in that context, what are your views on how people are changing in their behaviors with accessing banking and other financial services? And how do you think that we should think about making sure the consumer remains the key priority in all of this? So where have we got it right, or where is there more work to do?
Thank you. And I'll pick up on some of the things Kevin mentioned as well. And thanks for inviting me here to express views on behalf of the industry, and also obviously Permanent TSB. And I'll dip into both sides as I speak. So there's no doubt that the pandemic has just driven the whole digital agenda significantly. Why? Because of the restrictions that were in place during the COVID pandemic brought customers towards a digital interaction with the traditional banks, let's call it. But also we have the arrival at the same time of a number of fintech players who've to an extent in certain areas, particularly in the payment space, have raised the expectations of customers around how payments should operate in a real-time basis. There are challenges around that, which I won't get into, but that is something that the industry is working on in order to address those not deficiencies, but to catch up somewhat. If I take our own example, we started work during the pandemic. We started work on a digital current account opening process before there was any announcement of the Ulster Bank or KBC change, and we announced only on Friday that we've opened 100,000 current accounts, but 70% of those, or 70,000 of those accounts, were opened digitally. A year ago, we didn't have that offer, and in fact, we would find it, and I'm sure some of the other banks would find it difficult to do that in a manual way. So that we see as an absolute benefit to customers, because it allows the customer open an account, get their IBAN and start working on the movement of the direct debits into an account that's operational immediately. We're about to launch that for joint current account customers now shortly. So these are things where where the whole digitalization agenda has driven us on to make changes, and that will just continue. But from our perspective, it's not just about digital. Digital is important, but there's also the importance around connecting it to a branch infrastructure as well. Kevin was on the radio this morning talking about this, and indeed it's in by way of the CCPC analysis of the closure of Ulster and KBC, and the fact that customers still value branches. They still value that physical interaction. They don't necessarily go into it all the time. I don't even go into my branch all the time, but I know it's there. It's important. It's on the high street. I know the brand is there. So customers are valuing that, and they see it, and that's important. So it's about how you have that mix of making the branch important and viable for when customers come in for more complex interactions, which require some face-to-face engagement and the provision of potentially more information in writing, or by way of the more simple, straightforward transactions that can be done digitally in a very straightforward manner. And that's the balance that's needed and required. If I think of things that have worked very well, it's actually, when I see it as being industry collaboration, has worked very well. I know Brian mentioned the payment break story. Hopefully, I think the current account story will be seen as we're all competing for a current account. I mean, I want as many current accounts for Perm TSB as I can get, and indeed, if there's anyone out there looking for a current account, please come to us. But saying that, there is a coordination around how we think about the challenges of that, how we think about there will be vulnerable customers who may, towards the end of this process, will need specific help that we can work together on to provide that help. So I think they're areas of positive. I think areas where maybe it didn't work so well was the implementation of secure customer authentication, where banks, including ourselves, underestimated the support, particularly the technical support that customer needed in order to turn on push notifications, to really bring their phone up to a standard where they could make secure payments. And there was examples in the public domain where that just didn't work. So that's an area where we would have underestimated that digital transformation. And indeed, that's something we're all very conscious of as we think of our customer base, as maybe not as being digitally savvy as the people within the bank, the employees in the bank who are thinking about these services and products all the time, how we bring our customers with us. But I still go back to a point, and it's, if I take from our point of view, we're opening an additional 25 branches that are Ulster Bank branches. So we see the branch as being core to how we offer our service and how we support our customers.
So I don't know what to say. I've been involved in secure customer authentication from a different point of view, and I'm certainly, together with many others involved, in seeking to ensure that the banking sector work as a whole to be able to facilitate effective closure of bank accounts and, of course, opening of bank accounts for the customers that need to move. But it actually is a really good lead-in to asking Patricia, not particularly about those specific issues, but more generally, there's a truth that we have a changing environment with digitalization, but it doesn't change the fact that we're all people, and we always have been. And some of us are more digitally literate than others. Some of us have more acumen in financial services than others. But maybe all of us, at different stages of our lives, for a variety of reasons that could be permanent or transient, may feel unable to deal with the financial system effectively. And it's important that, I think inclusion was referenced earlier, but it's important that we have a financial system that works well for all of us, because it's a system that we all must engage with throughout different stages in our lives. Let that be just opening a bank account or more complex long-term products like getting a mortgage, and there may be different types of pension arrangements, or indeed other single purchase items. But it's important that that system can work for everybody. So what's your perspective in some of the key issues that we need to consider in the consumer protection framework and indeed the code?
Thank you very much, Derville, for inviting me, and indeed your introductory words are extremely important. So I'm really coming from it very much from a safeguarding perspective, and from that with the emphasis on inclusion. The discussion paper on consumer protection overview sets out the customer protection framework, which includes the OECD high-level principles on financial consumer protection, and it provides that all financial consumers shall be treated equally, honestly and fairly. Treating customers fairly should be an integral part of good governance. Firms should have an objective to work in the best interest of their customers and be responsible for upholding financial customer protection, and special attention should be dedicated to vulnerable customers. And a review of the various different jurisdictions by the OECD found that the majority implemented each of the OECD principles, and Ireland was deemed by the OECD to have fully implemented the principles. The OECD, however, did propose new principles in relation to access and inclusion and the quality of financial products. And it placed renewed emphasis on areas such as firm culture and consumers who are in vulnerable circumstances, or customer vulnerability. And the foundations of the Irish Consumer Protection Framework are set out in the draft review documents under 4 heads. And the heads include EU legislative framework, domestic legislative framework, which includes the Consumer Credit Act, the Consumer Protection Credit Servicing Acts, the Consumer Insurance Acts, the Investment in Intermediary Acts, and the Consumer Protection Act. And the next element head sets out the central bank codes, the main one being the Consumer Protection Code, and then firms' guidance and supervisory expectations. So given the increased emphasis on inclusion and consumer vulnerability, for those who need more individual support in order to manage their financial affairs, it is important that the Assisted Decision-Making Capacity Act 2015, which is shortly due for full commencement, and the Statutory Code for Financial Professionals and Financial Service Providers be added to the domestic legislative framework in the Consumer Code. So what is the Assisted Decision-Making Capacity Act about? It's mainly about dealing with people whose capacity may be at issue, but it has much wider implications. It was enacted in 2015, and as I said, due for imminent commencement. It enabled Ireland to ratify the UN Convention on the Rights of People with Disabilities, and while we signed it in 2007, we were unable to ratify it until 2018 because we did not have appropriate legislative framework in place. So it's all, that UN Convention is all about including people and not having disability tags or other tags on people, but treat them as an individual with their own individual rights. So it has very wide application. It applies to all peoples, organisations and businesses. The state has particular obligations. It provides in Article 12, for example, that state parties shall recognise that persons with disabilities enjoy legal capacity on an equal basis with others in all aspects of life. So everybody, regardless of who they are, they have equal legal rights. We have tended to exclude people from rights because they had a disability or because they were unable to engage with particular products, financial products, etc. So an important issue. It also says that state parties shall ensure that all measures that relate to the exercise of legal capacity should provide appropriate and effective safeguards to prevent abuse in accordance with international human rights law. So enabling and supporting a person to exercise their legal capacity is a key issue for people in vulnerable circumstances and for people who need support. So the Act, of course, will directly or indirectly affect us all in our lives, be it professional or personal. And that's really what it's all about. It's respecting that individual, and it is person-centred, not organisation-centred. So who is the legislation for? And very briefly, it's for a person whose decision-making capacity is in question or may shortly be in question in respect of one or more than one matter, a person who lacks capacity in respect of one or more than one matter, or a person who has capacity whose capacity is in question or may shortly be in question in respect of one matter and who lacks capacity at the same time to deal with other matters. So it's really important that in dealing, say, with interacting with financial services, a person may have the capacity to operate a small current account, but they may not have the capacity, they may lack the capacity to understand or engage in detailed financial complex investments. So the Act will bring many people who heretofore were denied access to financial services into scope. So it's important that financial service providers understand their obligations under the legislation. The Act provides for a number of legally recognised support arrangements, such as a decision-making assistant, a co-decision maker, or indeed where a person lacks capacity and it goes to court, then the court may make a decision or appoint somebody to make decisions. And of course, it also provides for planning in advance by EPAs or whatever. And there are a number of guiding principles which I think are very relevant to the code. And again, the code for financial service providers under the Act will say that these should be adhered to. And of course, as a result of Ireland ratifying the UN Convention, we're obliged to comply with these codes or principles. The first is the presumption of capacity, and while we have that presumption in common law for very many years, it is now in statutory force under the Act. And so it shall be presumed that a customer has capacity to make financial decisions unless the contrary is shown. So again, if we give an example of that in terms of banks leaving recently, Ulster Bank and issues, you had an older person in a nursing home who was there because they were old and frail, and in fact they had capacity, but it was presumed because their stage in life, the financial institution or receiving bank assumed they lacked capacity. So very important issues for inclusion. Again, another principle, a relevant person shall not be presumed as unable to make a decision unless all practical steps have been taken to support them to make the decision. Another principle, permit and encourage the person to facilitate them to be involved as far as possible in that decision. Give effect so far as possible to their will and preference. Take into account their beliefs and values, take into account any other factors that a person would be likely to consider if they were able to do so. So again, another clear example would be an equity release scheme, which a number of years ago, a number of these schemes were issued. They were issued to people who now need to apply for fair deal, and they are not they cannot apply for that fair deal because of the prior charge. So there's an onus on financial service providers to ensure that people have that information in offering products. Then consider, of course, the views of other people, and include now we have this situation where we must interact and engage with a decision-making assistant or a co-decision maker or any other person that's appointed. And again, of course, in terms of then how you assess their capacity, etc., we again have always reverted to the medical model. So presenting at a bank, again, banks were looking to people to produce medical certificates they had the capacity, rather than the presumption of capacity applying, supporting the person. So this is a hugely changed environment for all financial services that they're obliged to comply with. So the question is then, what products and services exist, for example, or are in development to support those adults to implement their own decision in line with their capacity. There is yet no evidence of products and services tailored to the diverse needs of adults who will now, in many cases for the first time, be afforded agency to make decisions in relation to their financial affairs. In addition, there are those who have capacity but who are digitally excluded. So again, it's really important that the principles in the Assisted Decision-Making Capacity Act are actually looked at in terms of what support should be put in place. Sage Advocacy identified the following support needs common to all adults who may be vulnerable to financial abuse, depending on their own individual circumstances. And that is to be enabled to control their own money to the greatest extent possible, the empowerment need. To have ease of access to their own money, accessibility need, to be able to use their own finances for their personal benefit in order to enrich their lives and reach their full potential, social and comfort support and need, to have their money readily and openly identifiable as their own accountability need, and to have their money kept safe. So the retail banks have shown leadership with the establishment of vulnerable customer groups over the years, and as well as, of course, the Vulnerability Forum convened by BPFI. However, this level of focus is really broadly required across all firms to ensure that the support needs of people are understood and addressed, and it is important that products are designed to enable and to facilitate access to agency. So really important. Again, there's little or current evidence that digitally only operated can provide the same level of support to people. And indeed, the OECD stated that non-traditional providers such as fintech could fill this gap. However, on further study, it found that non-traditional providers have mostly only managed to reach out to segments who were digitally literate rather than those who didn't have that facility. So there are many potential benefits that could be achieved by increased digitalisation of adults at risk, but these will only be realised when firms take specific needs into account and design around people to make sure that people are included. So there are a number of key issues to be addressed, and again, one recent one is the whole question of identification and opening a bank account, and that issue has been a huge issue in terms of the current banks leaving, and again, you need a digital pass to operate. So you need for identification either a passport or a driving license to have a digital account. So again, you're excluding a number of people, and also the technology itself isn't capable of understanding the needs or requirements of people who need to be included. So also, it's really important when banks are leaving, and you said also that, of course, about customers needing support. And of course, when banks are leading and digitalisation is increasing, we're coming to a situation where we're looking at a more cashless society. But for many people, of course, they still need cash. And in fact, the European Commission proposal in relation to users of financial services said that human interaction is still very necessary, particularly to include large groups of customers. So in delivering for the consumer in a changing world, it is important to ensure that innovation results in the emergence of products and services that empower adults in vulnerable circumstances to safeguard them, and also to ensure that they can engage in and with financial products and services. So thank you very much.
Thanks, Patricia. And that just shows us, I guess, the Consumer Protection Code is one element of the discussion about meeting the needs of protections and setting standards for consumers, but increasingly it sits in a wider context of European Union law and of course, national law, all of which any business operating in the financial services sector, indeed beyond, have got to master the obligations and how to structure their business so that they can offer the benefit of these innovations to their customers, so that it's a financial services system appropriately calibrated for all. And there will be an interaction with the Consumer Protection Code when we think about vulnerability, but it won't seek to displace other primary legislation. But I guess that's to be welcomed, because it represents a maturing of the thinking in our society. and it poses an opportunity for further inclusion. If I move next, though, to Neil, because SMEs are a really important and significant part of our economy, and it's important that protections are afforded to them and that their needs are met. So they've had a difficult period, undoubtedly. We have come out from the impact of the COVID crisis and the health impact, as well as the impact on businesses and their workers. But again, we're heading into, I think, volatile times with an increase in bills, and there was reference to access to debt and options for SMEs. So from your point of view, how do you think your members' needs would be best protected in this rapidly changing environment?
Well, thanks, Derville. For the people that I would represent in the SME sector, this is it's an interesting topic, because on the one hand, the code applies to everyone. It applies to all businesses in the conduct of their business with consumers. On the other hand, about half the active enterprises in the state, give or take, enjoy the protections of the code as well, because they trade below 3 million. And this is, I'll concede it up front, is a very difficult area for the central bank, because you're asked to come up with overarching regulation that is all things to all men in a very, very strange economy. So if you look at the big numbers, the Irish economy has a GDP of just under 430 billion. So if you look at that figure, and GDP is used totally inappropriately all the time, but Ireland is trading roughly at about the size of Israel, with a population that's nearly twice as big. But if you look at modified GNI, and that's really where the domestic economy is, that's trading at 230 billion, and that's half the size. So we have to regulate that space appropriately. And the difference between those two, to get away from the stats for a second, is you have about 270,000 businesses in the country, only 700 of which are large enterprises, and most of those are foreign multinationals. So all the rest are SMEs, and when I say all the rest, about 92% of those are micro businesses. They have less than 10 employees. They don't have any sort of legal function. They don't have a HR function. They don't have an accountant. So we have to generate regulation that they're capable of following without being overly complex, but recognizing that most of the time it also protects them, including some of the people in the room here, like insurance brokers and pension brokers and so on. So they enjoy the protection of the code as well. However, in terms of complexity, and we just heard just how complex one section of the code is from Patricia, what we would say is never forget that we're meant to do this, even though we don't do it all the time. We're meant to do regulatory impact on this stuff. And what they're talking about in Brussels now for a lot of new regulation is to say, when you identify a deficiency in existing regulation, you follow the one in, one out principle. So if that bit of that regulation isn't working, we just take that bit out and we replace it with something else. But we don't necessarily come up with a whole new corpus of law or regulation. Because there is a downside to regulation for us. We see that regulation protects consumers, but it also puts prices up for consumers. And a lot of the time, unfortunately, it reduces competition. So the tough times we're having, you're absolutely right, but part of that is the landscape the SMEs are in now. We've only 2.1 banks. Of our membership, they're 81% banked with AIB and Bank of Ireland, 14% with us, Ulster, 2% less with KBC. So you have 16% that's now trying to find a home in a bricks and mortar bank. And that only adds to the other woes that are going on at the minute. Absolutely, we are, and I don't want to put a hex on the economy, on the sector, but we are looking at a winter of discontent for a lot of those small businesses. they want to have the protection of the consumer code as they interact with bigger businesses, but we have to recognize that things like the consumer code and Solvency II, for example, impacts the cost of, for example, insurance. It influences the availability of underwriters for employers' liability and public liability, things that our sector are really against the pipes on now. So it is very, very difficult to get the balance right, and that's why I was so happy to hear you talk about the extensive consultation that's on the way.
So thanks, and it's really important that we hear the views and the effects on SMEs. And when we, again, I think your points underscore actually the European context that we operate in, and the code at inception in 2006 was actually a landmark piece of work in Ireland, because there wasn't an awful lot of other law protecting consumers or rights at that time. But the landscape has changed, and changed utterly since then, because, for example, Solvency II is European regulation that has been brought in to strengthen the resilience and the provision of insurance services, so they're there in the long term. And I guess that was seen as a reasonable trade-off. But of course we want choice and availability. And now, Peter, I'm going to come to you, but I know because you have many perspectives on what works for consumers. You know, if you could maybe say a few words, a little bit to pick up the earlier discussion. In the first panel, there was a lot of reference to consumer information, consumer education, and we know we're operating in a digitalized world where you can click through and buy a product real fast. And whether you are getting information that can work for you or not, some of that is within the gift of the central bank, for sure, in the code, and it's important that we hear about that. But you also heard from the first panel, some of that comes from requirements embedded in the kind of information that has to be provided to consumers. And it's fair to acknowledge there's I was going to say a raging debate, but insofar as debates ever rage in financial services, but there is a very serious debate about the effectiveness of a disclosures regime and whether that truly informs customers, or whether they in fact click through and they have information overload and can't assimilate that information. But what to do about that? So I think if you could choose some of the areas that I've covered there to share your views on.
Okay, thanks, Derville. I'll do my best, and good afternoon, everyone. I'm a behavioural economics professor, and I get invited to quite a lot of events like this because of that. And I think this is the first time I've ever been sitting on a stage or in any kind of panel and heard the expression, the weaponization of behavioural economics. So thanks, Kevin. Once I got over the sort of shudder that went down my spine on hearing that expression, I then thought to myself, well, why does it sound reasonable to use it? Why would somebody use it? And I think there is actually an answer to that, and from my perspective, it's probably a good one, which is what behavioral economics is doing is it's supplying solid, scientific, empirical evidence about how financial consumers actually make decisions. And of course, solid, scientific, empirical evidence is powerful, because it's fundamentally telling you truths about the world and how stuff works that may be surprising to you, may not meet with your intuitions. And if you want to make money, you can use it. And if you want to protect consumers, you can use it. And so that's why you can use the expression, the weaponization of behavioral economics. Now, given that, and in answer to your question, Derville, I mean, I think what I want to do, I was going to make 3 points about what the behavioral economic evidence tells us. And having heard this morning's discussion, I'm going to make 4, which is me violating evidence-based principles, because the evidence suggests if I make 3, you're much more likely to retain it than if I make 4. But I can't resist it, so I'm going to make 4 anyway, right? The first 3 are fairly straightforward and quite simple. We've now got 20, 25 years of empirical evidence that is consistently telling us that consumers of retail financial products struggle to understand the products that they are purchasing and make basic errors on a regular basis. And it actually turns out that that doesn't matter whether they're educated or not educated, whether they will be classified as a vulnerable consumer by standard measures or not. The overall standard of decision-making in retail financial services from consumers is far poorer than we originally thought when we started doing this work. And to this day, I get results in my lab that surprise me, even though I've been looking at this data for years. It's amazing the products that people hold that they fundamentally don't understand and make bad decisions over. It's not just my lab is doing this, there's labs all over the world that are showing this. So, you know, I can put loans in front of people, I can put mortgages in front of people where there's an objectively correct answer, where one is simply more expensive and not as good a product as the other, and a substantial proportion of people, educated or not, will choose the wrong product. If I ask them to explain to me basic relationships within products, so for example, if you reduce the term of a mortgage and increase the monthly payment so you pay it off a little quicker, does it reduce the overall financial cost of it? Most consumers can't answer that question. They don't understand that basic relationship between the attributes of that product. So that's the first thing. The first thing the behavioral economics is telling us, people don't understand retail financial products very well, and they make poor decisions with them. The second is doubtless related. And the second point I want to make to you is that consumers leave very substantial amounts of money on the table. Now, we talk very frequently about the way not switching does that, as if switching is just some kind of inertia that people don't get round to and they're leaving money on the table, and that's the conception of it. We've done a lot of work on switching. We're going to publish some work we've done with the Department of Finance on switching soon. It actually turns out really that switching is much more to do, or not switching rather, is much more to do with consumers not trusting themselves, not having the confidence to make those decisions. And actually, interestingly, often consumers' relationship between their own perceived competence and their actual competence is really weak. So people who've actually got quite high financial literacy don't switch because they don't think they're very good at it, and people who've got quite low financial literacy do and often make poor decisions because they think they're better at it. And the women in the room will be unsurprised to know that effect is larger among men. Okay? So consumers, yes, they don't necessarily understand. Yes, they make poor decisions. Yes, they leave money on the table. The other thing I can tell you from work we've done in our lab and done labs around the world is that the result of this is that consumers' decisions are very easy to manipulate. We've run multiple experiments now which shows that we can push consumers one way or the other at the point of decision very easily by how we present the information. And that's not by presenting false information or by denying them information. It's simply by how we arrange it. Or to use the expression that the behavioral economists use, that I see is in your review of the Consumer Protection Code, the choice architecture. Right? We can change the choice architecture, how the decisions are presented, in such a way that uncertain consumers who are worried about their confidence and actually a right to be because their comprehension isn't very good, we can push them in particular directions. So those are the 3 points I was going to make. The upshot of which obviously would be that from the perspective of helping consumers and regulating better, the choice architecture is the ball game. Right? How the products are presented and how people come to the decision and how they view the decision is where the action is. Not what the information is, not how much information is there, not what the background of the consumer is, how the product information is put in front of people when they encounter it in the marketing and at the point of decision. That's the ball game for consumer protection, and that's what behavioral economics is showing. And that was where I was going to stop. But here comes the fourth point, right? Because of what I've heard this morning. It would not be unreasonable of me, as a behavioral economist, having read the scientific literature, to say to you, financial literacy education does not work. Right? So I think it was Brian Hayes who said, we shouldn't have groupthink, we need some contrarian views. If that comes across as a contrarian view, here you've heard one today, right? Financial literacy education does not work. Okay, that's a slight generalization, not much of one. There's a bit of a dispute about whether you can just get a statistically significant effect on some trials or not, but overwhelmingly, the experience of 30 or 40 years of financial literacy education is really disappointing. Right? So if you look at these effects that I've talked about, people making poor decisions, not understanding stuff, right, and we find out whether people have had financial literacy education in the past, it turns out to have made no difference. And if that surprises you, let me just give you a very quick thought experiment before I stop here. Supposing, take this idea of educating transition year students, fine, okay? It sounds lovely in principle, it sounds like a great thing to invest our resources in. Supposing I said to you now you were going to go upstairs and I was going to test you on what you were taught in school when you were age 15 in a test upstairs, and you were going to have to use it, and the outcome of your performance was going to have financial implications for you, right? Do you think that you would be very good at that, right? Do you genuinely think that you can remember how an oxbow lake was formed? Okay, because what we know is that actually people retain 10, 15, maximum 20% of what they're taught at school, and that's an optimistic view. So the idea that that's the solution, that's where we should put our resources, I think the scientific evidence very strongly contests that. And although it sounds great to talk about financial literacy and education programs, it sounds great to be investing money in them, that's not where the ball game is. It's going to at best have a marginal effect. Where the ball game is how those products are presented to people, how fair those systems are, and what that context is, what the choice architecture is, and that's what the behavioral economics shows.
So, at risk of giving you another platform, I'm actually going to do what I tried or said I would try to do earlier, is get some audience participation. I'm going to go to some of the online questions first, and then we'll hand the mic around afterwards. But I have a question. My first question then to you, Pete, is that one of the questions is, we largely seem to focus on older people when we talk about vulnerable people. But what about younger people who have access to easy credit on their phones, buy now, pay later schemes, and more besides? How do we improve their financial awareness? I couldn't resist, given that you said there may be no hope.
I said there may be no hope?
For education. So I think you're going to tell me it's about the choice architecture.
You're absolutely right, Anne, but I'm going to tell you something else first, which is that all of our data suggests that older people make better financial decisions. Older people are not more vulnerable than younger people when it comes to financial decision making. They make better decisions. There's a reason why. Precisely because financial education isn't particularly helpful if you have it, and most people don't have it anyway. What actually happens is you get better at making financial decisions as you get older, because you get more familiar with the products, you have more experience with them, you get burnt a few times, you meet more friends who tell you more about it, you learn as you go along. So older people are better at making financial decisions. That's what all the data shows. But this focus is absolutely right on the idea that, okay, younger people are going to be more vulnerable through these digital platforms. Yes, they are. Okay, I agree with that. So what needs to be done about it? Well, one of the things that's absolutely great about digital platforms is you can test them. Right? It's extremely difficult to regulate an environment where somebody goes in to see someone in a financial services provider and is having a one-to-one discussion with them. And how do you regulate what's said to them, what isn't said to them? Right? When you're on a digital platform, you can absolutely regulate that environment because you can see it, you can look at it there, and you can experiment on it, you can test it. Okay? Now, a couple of points about that. I mean, we've recently run a study that CCPC funded. You can definitely change the choice architecture for better. We ran a study funded by CCPC in collaboration with Bank of Ireland where we managed to increase savings levels of households, particularly low-income households, by changing the choice architecture of the way the savings products were presented. So you can change the choice architecture for the benefit of consumers, absolutely. But to do that, we did that through experimental means. We did that by testing and then by doing a controlled experimental test of that environment to see what promoted good choices. Therein lies some of the answer. In my view, if it is true that digital environments are going to be where younger people make these decisions, and they're more controlled environments that we can test, then we should be testing them. We should have a regime of testing the environments in which people are buying mortgages and loans online and savings products and investment products online. And perhaps we could also think about, well, hang on, how much responsibility should the regulator and the public sector, commissioning researchers like me to test these things, have? And how much should we push that responsibility onto providers to say, you should be testing your environments. You have digital environments here that are making a lot of money, getting a lot of customers. Maybe you should be testing those environments and showing to us that your consumers do understand the product that they're buying, that the environment that you've produced produces good quality choices compared to other possible environments, or some plain vanilla environment we might put in front of people, for example, sort of standardized one. So we really need to think with these digital environments about how we regulate that choice architecture. Can we do it better, and can we get more testing into the way these environments are produced?
So that's really helpful to me, because I think as part of the central bank and the way we like to think about regulation is technology neutral. You should get the benefit of the protections of regulation, whether it's to do with digitalization and online services or a face-to-face experience. So what does fairness mean? What does best interest mean? And I'm going to marry this with an area that Eamonn was going to talk about, which is operating in consumers' best interests. We have a question online asking us, would the central bank consider part of the revised code providing firms with more specific guidelines on the fair treatment of vulnerable customers, similar to the FCA? But it links into best interests of customers and how to approach this. Do you want to tackle this and maybe add on some views?
Yes, it's a good question, because you know, it's about how do operators, how do banks, financial services entities have that balance, obviously keeping the best interests of customers at the very core, but also financial service industries have to be sustainable. They have to make a return. In a banking sense, you have to make a return in order to, you know, maintain your regulatory coverage and meet customer needs, but also lend back into the economy. And even though it was mentioned 2.1 banks, we're the 0.1 that wants to lend more to businesses and to create more competition in the market. And we will be more than 0.1 in due course. But coming back to that, that balance is important. And you know, it is a challenge, but I think it's about common sense. It's about understanding what your customer needs are, how you think about where they're positioned, how you balance that digital and personal interaction in a way that the more complex transactions are dealt with on a face-to-face basis. It's not about digitizing the journey. It's actually about thinking about making it more efficient, more user-friendly, but also having that interaction. And I'm not aware of the FCA guidance on best interests in that respect, but I will have a look at them after this, after today. But I believe it is a challenge, there's no doubt about it, and there has to be a proper balance amongst all stakeholders in that respect.
So I'll just say that certainly as part of the discussion we have asked some questions about whether more articulation of some of the elements in the code would be beneficial, but I'm going to talk about trade-offs now. What we don't want is then to end up with a closed set of rules that if it's out or in, it's binary. It's not. I do think that as we talk in our work in Europe and at home, we talk about outcomes delivering for consumers. So certainly we're very open to the discussion around suggestions, what should be done, what would improve things. But a trade-off that would need to be thought about is to make sure you don't end up with a closed list and you don't deliver the positive outcomes that we would want to see. The last question that I have here, I don't know if somebody could volunteer to take it, if anyone feels they want to take a stab at it. It's about EU Capital Markets Union, and does the panel see a risk that the initial product control and governance will be weak, leading to unsuitable offerings to consumers and retail investors? If not, I'll default myself to that one, which is to say Capital Markets Union is not something that's going to happen tomorrow. It's something that's been going on for a long time, and like many things in Europe, it's built over I don't know, time, where things move slowly, and then iteration that is fast and comprehensive. We already have a very large fund sector serving the needs of investors, helping them save for their future. We have PRIPS, we have passporting regimes, and there are more initiatives. And one of the key areas, and I'm sure this is a plug for you to come back tomorrow to listen to Commissioner Mairead McGuinness. I know that a key area of focus for her is to marshal consumers and their investments into the capital market to the benefit of those consumer investors and to the benefit of our economies. And we already have very clear understanding of product design, of target market audiences, and it's about the product and the sales channel, but now we know it's really about the choice architecture at the purchasing interface. But I am confident that, of course, we can have risks, because that is the nature of financial services, but I am confident that this is an enterprise worth taking, and taking well, because we have pensions cliffs to face, and we need to support investors in having suitable choice. So, of course, there's a risk, and famous last words for an optimistic regulator, but I think it's important that we pursue this. It's something we've been talking about for many, many years, and it's still in the making. So I think it would be important for us to make ground on this. So late, but eventually, if we could see if we have questions in the room, please. And we'll try to take 2 or 3 together to see, oh, now we have loads, that's great. So I see 3 in front of me straight away. So no pressure on our panel. I'm sure they'll be able to answer everything comprehensively. And if you could tell us your name, please, and if you're representing yourself or an organisation.
Hi, I'm Anne-Marie O'Connor, and I am a board member of Safeguarding Ireland, and I also sit on the Consumer Advisory Group. Just an admission, I fully agree with Pete about the limits of financial education, and where I'm kind of optimistic is that actually digital products can improve, the way in which we consume, because some of the vulnerabilities can be designed out of the products. So we can build in safeguarding, design out vulnerability. But where I'm kind of despondent then is when I look at the Irish market, I wonder where that innovation is coming from. And so I very much welcomed the emphasis on innovation within the draft documentation preceding the code. But where is the source of innovation for Irish consumers? Who's driving it? Is it a policy matter? Is it a regulatory matter? What's the market doing? Is it for incumbents? Is it for fintechs? If, as Pete said, it's to do with the choice architecture, we can have life-enhancing products and services, but who's developing them? So it's a question. Thank you.
Okay, that's great. Thank you, Anne-Marie. If we could go, I saw 2 other hands up here in the centre as well. So that's, you can think about who wants to answer, who is driving the innovation.
Hi, thanks very much, Derville, and a very enjoyable conference so forth. I think given we're coming close to lunch and we're in Lansdowne Road as an ex-rugby... Sorry, Michael Brannigan, Community Credit Union. And I just thought, given we're in Lansdowne Road, as an ex-rugby player, I can't let Eamonn have a free run to the line as he has. I'm delighted to say that the credit union movement are major pushing the whole agenda of trying to look after our members. Obviously, we're not for profit. We've now launched into the current account market as well. And we've just been announced for the 8th year in a row as the most trusted brand in financial services. I'd be keen to get the esteemed panel's view of how important a role they think in the digitally transformed credit unions, which has given us new access to better serving our members, how important they think we could play a role. I think we've more branches collectively than the other major participants put together, and obviously are serving very much the members. So I'd be curious to get the panel's view on that. Thank you.
Thank you.
Hi guys, Jacqueline Thornton, Insurance Ireland. We've talked a lot, I think, in this session about regulatory requirements for consumer protection to try and prompt engagement from consumers. We've talked about financial literacy. We've talked about behavioural economics, which has been used as a regulatory tool in other jurisdictions, Pete, but not a panacea, unfortunately, because there will still always be a cohort of customers that no matter how much we as financial services firms try and prompt engagement or we try and get a response, will simply not happen. And nowhere are we seeing this better at the moment than the level of direct debit switching up as a result of the retail bank's exit, which is actually quite high considering firms have been contacting consumers, banks have been, and we've got quite a high profile awareness campaign. So, where does the responsibility for these customers sit? How can all market participants, as the Governor referenced earlier on, work together to really continually try to stimulate a response and an engagement for these consumers?
Okay. Conscious that we'll run out of time soon, I'll take one more question and then maybe I'll ask everybody on the panel to give their final words addressing some of the issues raised as they go along, or any other point they like to make. I saw a lady, I think, over here. Hi.
Hi, good afternoon. I have a follow-on question from the lady.
Sorry, just tell us your name.
Oh, apologies.
Please.
Electronic Money Association, Sinead Walsh. So obviously I'm very interested in the digital piece and the question that arose here around who's driving it. I hope we have some impact with our members in driving the digitalisation with our big fintech membership here in Ireland. But for me, I'm more considering the opportunities and threats arising around this really interesting piece on it's really at that decision-making top, piece. So I'd be really interested to get some views on the panel, not just from Professor Lunn, but from everybody on what are the opportunities and threats. I won't even look at the SW, but what are the opportunities and threats arising from a consumer protection viewpoint, and how can that be tied into the considerations around the revamp of the Consumer Protection Code?
Okay, thank you, Sinead. I'm going to close it there, conscious that we sit between you and your lunch. And if I start maybe with Kevin and work our way down the line and see, can you share some views and seek to deal with some of this along the way?
Thanks very much, Derville. Maybe if I finish on two comments. One was just to pick up the innovation point. As the competition authority, when we look at certain scenarios, innovation is key. Where there isn't enough competition, one of the side effects is often lack of innovation, because there isn't pressure on firms. So just one remedy we had in relation to the KBC transaction was a funding of entities who will try and bring innovation to the provision of mortgages and around the switching issue. So that was an example. Second piece where we recently also had a decision in the banking sector was around cinch payments, and that was to introduce certain, these were offered up by the parties, but there were certain controls to make sure the market wasn't foreclosed in any way. So I think, that's just an example, I suppose, where we've been on the pitch on innovation, and we bring that lens. Maybe just back to our discussion, and it was actually something Patricia mentioned in the OECD principles, which I know are referenced in the Consumer Code discussion paper. And it's that idea of quality financial products, which is a new OECD principle. Picks up on a lot of Pete's points, because it involves defining the market, conducting research, and carrying out testing. And it's back to the discussion we had that the firms, if they set about this right, can really understand their consumer, their market, their proposition, and make sure it is in the consumer's best interests. And I think it actually ties back a little bit to the discussion this morning on the individual accountability framework in SEER, that through that framework, for the large firms at least, we can ensure that there are individuals at a high level in the company who have to keep this in mind, who are there with this desire to have quality products for the consumer. So that oversight is a key part to that as well.
Thanks.
So I'll touch on one or two of the questions, but I suppose if we think about I think it's a perfect time to be reviewing the code when we look at what's going to happen over the next 10 years around the financing the transition. We have an aging population. That's not all about vulnerability either. All of us can be vulnerable at some stages in our lives, no matter, depending on what happens and on the situations we're in. So it's not just age-related, but also then the technological changes that are happening. And indeed, from a financial services point of view, you can see around the evolution of the traditional banks in Ireland from 5 to 3, the transformation of electronic payments. Cinch is part of that Kevin has mentioned, to try and provide Irish customers with something that can compete on an instant payment basis. There's also new fintech, there's new business models are evolving. There's open banking and open finance, which is taking hold as well. And we've got foreign players who want to come in and effectively eat our lunch in that respect. There's also the role of data and how we both manage data but also protect it. Increasing fraud, we can see it in the papers and in media every day. And also, as I mentioned, funding that climate change. So significant challenges ahead for all consumers and all operators within the ecosystem and all stakeholders. So this review is absolutely timely and welcome in that respect. I think with regard to the credit union question, we all envy the position that the credit union have by way of being number one for 8 years now, is it, on the trust score. I personally think the credit unions are competing. I think you have 60% of the consumer credit market already, which is an area where the banks are trying to reclaim some of the personal lending and term lending type areas. So that is an area of where, again, we're trying to take back some business. I think there's absolutely an opportunity in the mortgage space, but I'm not sure. I think that's a collective amongst all the credit unions to get together and do something about that. And then there's this question on sustainability, so being liability long and asset short or lower assets, so how to make that balance. But there, from my perspective, and I believe from an industry perspective, there's absolutely a position for credit unions in this market and dealing locally. I'm an old credit union customer myself, and my kids have credit union accounts. So just to mention that, deposits, no, I have to say that. And we envy your position in that respect. And from our point of view, personally in Permanent TSB, we're trying to mimic some of that through our branch network. By way of, there was another question. I won't necessarily answer all of the questions, but there was a question around who is developing products and who is providing innovation. I think pre-crisis we saw an awful lot of innovation, particularly in the banking sector. You could argue, I know this might sound strange, but we had too many competitors pre-crisis, and that drove behaviours, particularly in the mortgage market, which led to 100% LTVs or over 100%. It led to an extent, the tracker product, which from an asset liability point of view made no sense on a bank balance sheet because you couldn't actually hedge it. So I wasn't around, by the way, so just to say that, but just it didn't make any sense by way of as a banking product. But that evolved by way of, I'd suggest, an over-competitive market. I know that's controversial in a way, but it was just over-competitive. So there is innovation in the market. It is, we can see it in some of the mortgage products to an extent, but it's more on pricing. And some flexible options in that respect, and maybe there could be more done in that area. Cinch, I'd suggest, is innovation for the market. It will bring the Irish retail banking industry, plus any other player that wants to come in. It's open to anybody who wants to come in and have cross-societal instant payment and instant settlement through your mobile phone. So that I think will be a significant move forward in that respect. And then in the wider industry, I can't answer for the insurance industry, but there is a fair amount of competition in that space, bringing different products, etc. But it is a fair challenge, and if I again, from an Irish banking industry point of view, we have spent a decade kind of looking back. We are clearing off most of the legacy issues. There are a few lingering around, but most of them are clearing, which gives us a chance, obviously, to look forward and to show what we're worth by way of our position in society. Lastly, I just want to take this opportunity. I'm also the president of the IOB, or the Institute of Bankers, for my trouble. But education is really important. Education amongst financial services staff, but also education for the wider society. And there's numerous courses that the IOB offer today, which delve into culture and ethics, into consumer protection, into lending practices, you name it. It's not just for people in banks, it's also for across the financial services industry, and I'll make a plug for them. Our membership is growing, it's not reducing, and I'll make a plug for education.
I'm not
Thank
going
you.
to charge him for that plug.
Yeah.
I'm okay with that one. But if I could then turn to Patricia, Neil, and then Pete, but ask you, given that we'll keep an eye on time, if you could have a heroic summary, that would be appreciated.
Well, I just want to raise issues about some of the terminology that's used in the code. First being vulnerable customer, and of course that does excite people in terms, and people do think in terms of older people, whereas somebody did say, of course, lots of people who need support are across different ages and whatever. That's important. The FCA has looked at, say, a person in vulnerable circumstances. On the other hand, I think the more preferable issue is a customer who needs additional support and assistance, and that's the Ulster Bank started to use that terminology, which I think is far more appropriate. The other term then is best interests, and I know it has its origin in the OECD principles. It was an issue that took quite an amount of debate when the Assisted Decision-Making Capacity Act was going through. And of course, one of the principles in that Act is it doesn't use the word best interest at all. It's eschewed using that term. So the principle is at all times act in good faith and for the benefit of the person. And of course, when you're talking about best interests, no matter how you couch it, and there have been detailed definitions, say, in the English legislation, capacity legislation, about putting the customer in the centre. But actually, in a review of that Act by the House of Lords, found that people revert to the old paternalistic interpretation of that you decide what's in your best interests. So again, I would say in the code that we look at that in detail, and I mean the 2015 Act is talking about acting in good faith and for the benefit of the person. So it's the person is the centre making the decision for themselves.
But I'll just get clear, the code won't interpret other law. It'll deal with separate matters but try to integrate them well.
Yes.
Thank you.
Derville, I'm going to rip through. So Capital Markets Union, bring it on, because we're not tripping over customers as we are, or competitors rather. Protection, safeguarding, what I'd say is what Pete Lunn has said is really important to us, but for different reasons. So think of cookie permissions. Do they do what they're meant to do? No, they don't. So if you're adding cost and complexity without adding value to the customer, you don't do it. And if any regulators in the central bank have not done Lean Sigma training, they should be doing it before they write regulations. Credit unions, we want to see them actively involved in the lending process to SMEs, because the stripping out of the bank manager layer has really crucified SMEs, especially regionally. Switching is not going well. We're getting weird stuff coming in about know your customer and show us a business plan. We just need to effing switch, okay? And lastly, digital, who is driving, please look at what the new competitors are doing, how easily they can do it. Bunk, N26, Revolut, if they can do it, domestic banks can do it.
Thank you. And just to confirm that a whole load of our staff have done that training. Good. And I know Colin Kincaid will be delighted, because one of our last meetings, he was off to award accreditation to various staff and celebrate that achievement. Pete.
Okay, I'm going to give myself 60 seconds. So I'm going to try and wrap these good questions in, right? On the engagement piece, what can we do? I don't know. Do digital platforms offer us an opportunity to test some things and try some things? Absolutely. You know, whether it's kind of gamification, whether it's quizzes, whether it's providing people with support apps when they're first coming to buy mortgages, whatever it happens to be, I think there are real opportunities to do that, but that requires research, development, and testing, so it overlaps with that question. Who's going to do it? I'm deeply skeptical that our traditional providers are going to deliver these kind of benefits and platforms to consumers. Why am I deeply skeptical? Because in my entire lifetime, they've failed to do it so far, right? Inductive logic tells me that's unlikely to happen. I'm also pretty skeptical about the power of third-party intermediaries. Why? I've used third-party intermediaries to save myself enormous amounts of money, actually, over the last 10 or 20 years, and almost all of the ones I've used are no longer in business because they went bust. It's incredibly hard for the third-party intermediaries to make a profit because people just want to use them for free. Where does that leave you? It leaves you with the public sector needing to regulate more strongly on the choice architecture and needing to be much more innovative about supplying these services and researching these services itself. Shout out to the CCPC website, which is brilliant, and I say that on the radio all the time. I use it myself, and I try to get other people to use it. But we can do an awful lot more than provide a website with price comparison services, right? We can research other things. We can research some of these other ideas. But I do think a lot of that drive is going to have to come from the public sector, and that's a pretty old-fashioned view, but my experience has told me that's true.
Okay, so I thank you for your time. I hope you've had some benefit and value in this discussion. I certainly have. And I don't know if this is a promise or a threat, but it's one of many. And there'll be plenty of more opportunities to engage with us on the code and about the national architecture and framework. Thank you for your time and enjoy your lunch. Thank you.